Hi, my name is John Garvin. I'm the president and founder of benicoltd, an employee benefits consulting firm based in the far northwest suburbs of Chicago. We are pleased to present this video about voluntary benefits as one in a series of videos designed to provide a basic level of understanding around employee benefit concepts and ideas that would be of interest to owners and managers of businesses of all sizes. Given the high cost of providing employee benefits and particularly health insurance, employers in the United States are increasingly adopting a defined contribution approach to the benefits packages they offer. Defined contribution is exactly that. Employers determine how much they are reasonably able to afford as subsidies towards benefits, and in so doing they define their contributions toward their core employer-sponsored benefit programs. The financial responsibility for anything beyond that is then up to the employees to pay for. Defined contribution really replaces a defined benefit approach wherein the employer bears the brunt of the financial risk in the financing of benefits. In fact, this trend away from defined benefit and toward defined contribution correlates with a similar trend that we have seen in this country over the last couple of decades with respect to qualified retirement plans. So much so that the defined benefit pension plan has virtually become extinct, having been replaced by 401k. Given this clear trend with the financing of health and welfare benefits, employers are increasingly offering menus of voluntary benefits to supplement the subsidized core employer-sponsored benefit programs. In a sense, the employer is sponsoring the voluntary benefit offerings, but this sponsorship has entirely to do with the fact the employer is providing employees with convenient access to these benefits through payroll deduction. Employees win because they gain access to voluntary benefit products and services they want and need that otherwise might not be available to them outside of their employment. Employees also benefit from the tax sheltering through Section 125 of any health insurance-related products that are purchased. These products are offered either at group rates or discounts are offered using individual insurance products, and typically there is little or no medical underwriting to qualify for coverage. Examples of voluntary benefits are disability, life, dental, vision, supplemental health, accident, and critical illness insurance. For the benefit of our viewers, I'll take a few minutes to explain some of the features of all these types of voluntary insurance products. To begin with, voluntary disability insurance products provide benefits over and above basic health insurance, offering eligible employees income protection insurance in the form of benefits that partially replace income lost as a result of disabling non-occupational accident or illness. When such an event takes away the ability to bring home a paycheck, voluntary disability insurance coverage can help fill the gap as payments may be used for any purpose, including ongoing bills such as paying rent, mortgages, educational expenses, food, and car payments. Next, there are voluntary life insurance plans that allow employers to provide, at no cost to them, life insurance to eligible employees at reduced group rates. The two primary types of life insurance that are typically offered are term or whole life insurance. Term insurance offers protection for a specified period of time and builds no cash value. If the insured dies during the specified term, then policy benefits are paid on a tax-free basis to one's beneficiaries. Products offering varying durations and benefit amounts and often include embedded benefits for terminal illness and accidental death and dismemberment. Coverage durations can either be annually renewable or level for periods such as 10, 15, 20, and 30 years, during which time the premiums remain unchanged and the level of coverage stays intact. Whole life insurance, on the other hand, can play a valuable role in meeting current as well as future financial needs. Features of whole life plans include premiums that remain level throughout the life of the policy, guaranteed renewable protection that cannot be reduced, and accumulated cash values that may be withdrawn, borrowed against as a loan, annuitized, or used to purchase extended or reduced paid-up insurance. All whole life plans have guaranteed cash values, and depending on the issuing company, may also include dividends that are paid annually. Third, a clear trend because of the high cost of health insurance is for employers to offer little or no subsidy toward the cost of either dental or vision coverage if it's offered at all. The good news is that there are many insurance companies that now offer dental and vision plans on an entirely voluntary basis. And since the benefits under these plans are somewhat limited, the premiums are reasonably affordable. What helps even further is that the premiums for these plans, as well as for supplemental health, accident, and critical illness insurance products, can be tax sheltered through a company's Section 125 plan. Fourth, as healthcare costs continue to rise, supplemental health insurance products help employees meet their financial obligations when they are hospitalized or incur expenses when receiving outpatient or inpatient treatment. Cash benefits paid by these policies may be used to help offset the loss of income, experimental treatments, transportations to doctors and treatment facilities, or for normal living expenses. Fifth, offering protection beyond basic health coverage, voluntary accident plans provide supplemental on or off-the-job coverage and may be used to cover deductibles, out-of-pocket expenses, and other services that one's health insurance does not. Voluntary accident plans can either provide expense reimbursement or an indemnity benefit. Expense reimbursements are paid for actual covered charges, whereas an indemnity benefit pays up to a maximum stipulated amount depending upon the nature of the accident. Finally, there are critical illness insurance products. When an individual is first diagnosed with cancer, heart attack, or stroke, his or her life is interrupted in many ways, physically, emotionally, and financially. Employers demonstrate their concern for their employees who face such challenges by offering critical illness insurance. These plans help an individual's ability to maintain adequate earnings for everyday living expenses. The benefits for critical illness insurance include cancer expense policies that may be paid either through a lump sum or through an annually restorable policy. Premiums for lump sum policies do not increase with age and are typically payable until the policy is paid up at a specified age or predetermined number of years, or until a claim is incurred. Often, critical illness policies offer a return of premium rider, which allows premiums to be refunded if the policy remains continuously in force and no claim is paid during the term of the policy. Annually restorable policies, on the other hand, help offset expenses incurred for treatment of covered diseases. Payments typically are more focused toward inpatient or outpatient services, as well as for supplies and treatments such as hospital room and board, drugs and medicines, laboratory services, and medical or surgical services. That concludes our overview about voluntary employee-paid worksite benefits. If you have any further questions about this subject or would like to consult with an employee benefits professional about how to incorporate voluntary benefits into your company's strategic plan for its employee benefit package, please give us a call at 847-669-4800. We're glad you joined us today, and we hope that you'll take the opportunity to view the other videos in our series around employee benefit concepts and ideas of interest to owners and managers of businesses. Bye for now.